Good afternoon, ladies and gentlemen, and welcome to those who just stepped in. We continue with the Partnerships with Purpose program, where we're dealing now with the unlocking access provisions through digital technology industry and financial service provider partnerships. I think one of the critical areas of sustainability is access to financial partnerships. You know, be it with your bank, be it with your insurance company, and be it with any financial service provider. One of the things that you find is that, you know, I was sitting in the other plenary, in the other session just now, where we were talking about SMMEs, and one of the things that came up was the issue of finance and access to finance. And you suddenly found that there was a retard in the way that people express themselves because of accessibility. You know, they have brilliant ideas but no access. So we want to kick off the session. It's a very important matter of financial inclusion. And just for purposes of introduction, my name is Prabir Badal. I am a director at the Center for Digital Transformation and Innovation Africa. We are a digital transformation and a skills development provider in the 4IR stream. Using AI, extended reality, Internet of Things, and a whole lot of other streams, we provide services, training services, as well as developmental services for that. I'm going to ask the panel, starting off with with Sachin, just to tell us what your view on financial inclusion is.
Hi, everyone. So,
just introduce yourself.
My name is Sachin Ram-Asary, and I'm from a company called VRAM. We're a tech company. We do a lot of work with financial institutions, mobile telecoms, research at government agencies, and primarily along the lines of AI and data, right, and bespoke software. So I've been in banking now and technology for probably about, good Lord, over 2 decades. I'm old. And I've seen the ins and outs of this. And I think one of the fundamental issues with financial inclusivity is that it's been very much a push situation, right? It's either been regulated that people need to be financially included, or it's been a push situation outside from financial institutions that have basically said we need to tap into this unbanked market. And this unbanked market has been force-fed products, right? It's been force-fed products by banks that fit their internal value chain, right? It has not gone out and necessarily looked at how the market operates, how those aspects link together, and essentially, what it is people want. People want services. They want financial services. The easiest way to look at it is when you look at these fintechs offer specific modular services, right? One offers a payment service, one offers, whatever it is, a vetting service, one offers something else. And these services get chained together and basically become that financial services value chain that people want. Right? It's not that people want a banking product. They don't want they might need an access loan thing that some bank might call it. They might need a savings account. Yes, they do. But they need the services that are chained together, right? And they can pick and choose which ones they want. And essentially, they build their own financial services ecosystem, right? And I think just from an opening perspective, that is essentially, from what I've seen, is what the market is kind of demanding. I'll get into some of the other stuff later, but Tejal?
Yeah, I think having done core banking implementations, we go in with a very predetermined set of solutions and offerings. We don't really look at what the consumer needs. And I think a common theme that I've picked up in today's discussions is we operate in silos. The economy works in silos. We don't have an integrated model within our economy that creates opportunities and access to funding. So to your question, one of the biggest barriers to entry for startups and actually doing business is the access to funding. And if we look at, where we are as an economy, we are severely lacking in understanding what the person on the ground needs and providing the solutions. And I'm going to give my friend from African Bank an opportunity to give us some insight.
Try this mic. Thank you for the hospital pass. My name is Thuthuka. I am from African Bank. I head up the digital lending component of SME banking. And I think my colleagues on the left, I think you've been spot on, right? I think we need to move away from big corporates and banks looking at these SMEs and ecosystem and trying to see how they can extract value and how they can make profit out of it, because you always hear the numbers, right? It's 900 billion rand, big industry from an SME and informal segment. But rather to shift the focus and say, how do we contribute to it? How do we add value? Because those ecosystems are operating, but they're not taking up some of the banking products because there is a gap in terms of what we think we want to provide and what it is that they're looking for. So maybe a starting point is, listen, understand what the needs are, and then come up with products and services that fit the ecosystem and are easy to consume. I think that would be our starting point.
Kevin?
Good afternoon. My name is Kevin Govender. I'm an executive partner at IBM, also a professional CIO. And I, over my last 28 years, I've been helping organizations with digital and finance transformation. If I look at the world where it is, we talk about partnering with purpose. And the first thing is, I believe that, just the word partnering with purpose is the ability to partner with those companies that have similar values, similar culture, and similar objectives is very, very important. I think that's the first thing. The second thing is, if you look, from a South African perspective, I think one of the things we pride ourselves in is that we have one of the best financial frameworks across the world. And those are the things saved us when other countries or other economies went through a difficult area. That helped us. That's one thing said. The second thing is we have, from a regulation perspective. But I think if you look from the banked versus unbanked, and if you take the statistics, I think there's far a lot more we can do to be able to understand the requirements of the unbanked and how we can turn that into opportunities. I mean, I was in India a few months ago, and I'm not sure if you're aware, India is over 1.3 billion people, but they are cashless. You can go and buy coconut water from the street or a pineapple that there's somebody, some spaza shop is serving you, and it's got a QR code.
Even the beggar has one.
Right? UPI, various Google Pay, whatever. And everybody has a cell phone. So what they've done is they've digitized the whole payment system across the world. What prevents us from Africa or South Africa to be able to do this? We're part of BRICS. India is part of that. It is not a very difficult thing to do. If you look at the fintech capability and capabilities and technology that we have in the country, I think there's many platforms and companies available where you have private partner, public partnerships to be able to do this. I want to talk about something else, but I think I'll save that for later. I think, there's obviously the conventional ways of getting funding, but there's also other innovative, modernized ways like Lendico and Rainfin, and I think we'll elaborate that on later.
So what do you think are the impediments that lend itself to having almost 20 million people unbanked in this country? Surely it would be good to have them in a system. But in all honesty, some of these, very much part of the 20 million people don't feel secure or don't feel that their monies will be secure in a bank, because as you said earlier on, we're just chasing a number. We're chasing the profit. Banks are chasing the profit for a 900 billion rand segment of the economy, and they already calculated, they did the quantitative analysis around how much of profit they could make out of that 900 billion. So what are some of the impediments that come in? You spoke about technology. you know, what's some of the technology impediments, regulations, etc., that affect people having access to quality finance?
So look, I can approach it from an SMME perspective, right? Because essentially, from a personal market perspective, we're relatively well banked in terms of that. And in most instances, if somebody wants a bank account, they can generally get it. But there's still that gap in terms of why should they have one? And it goes back to the value and does it meet their needs? But from a business perspective, from an SMME perspective, we see a lot of small businesses leveraging their personal bank account for business usage in terms of that. We find that they don't see the value in opening a separate bank account for the business. And you find that they operate in very cash-heavy economies. We've still got accounts that are more digitally focused in terms of that. So I think it always leads back to there's a gap between the products that are being demanded and the products that are being put out there. I think that it always starts there. But secondly, I think there's a big portion around education, financial literacy, you know, how to start, run a business, how to manage your finances, how to keep records in terms of that. And you see that now pushing through from having a bank account is just the start of financial inclusion. But access to finance is where the kicker is. And how do we then leverage technology, AI, to actually then start lending to people that would not traditionally lend to because we'd see them as a slightly higher risk. And I think for me, that's where probably the axis of the conversation needs to gravitate.
Kevin?
Yeah, and I think, you know, there's always a need, and it's a supply and demand, right? So the one part is understanding clearly what the unbanked requires. And if you look at it, I think fees. If you can do everything with one bank account, you can reduce your cost of your fees. But if you're going to have multiple, the cost, and lots of people cannot afford this. They would rather take that money, especially small businesses. Now, if you look in South Africa, we have lots of challenges, right? I mean, unemployment is sitting at 32.5%. We have a lot of people that probably have their own farms but don't have access to capital to be able to whether buy equipment or buy plant to be able to maintain that. So if you look at in countries like Kenya, Hello Tractor originated. Now, not trying to deviate, but that's an alternative way because one way is owning, the other way is access to something that you only need when you need it. Yeah. So I've written a book called The Rise of the Sharing Economy. And part of that, I looked at what are the various business models that are available out there in the world that people could use. Now, it normally takes 21 days to plow a land by doing it yourself with manually. But if you had access to equipment, it'll take you 8 hours. Now, that's important because what that means is I can actually use use technology to get access to this Hello Tractor. In South Africa, we do have a company. It's called AXL, and be able to do this. The other thing is, for example, I presented to 80 We Think Code students, mostly females, that We Think Code is looking to develop into software engineering. And the reason they're developing these kids is because if you look at the 17 sustainable goals that we have, every one of them, technology can be used as an underlying power to be able to create capability. So one of the things I encouraged them 3 weeks ago, and I said to them, find one of those goals, whether it's food, whether it's education, and find what is your purpose and how you can use software engineering, which you are learning, to be able to develop some app that can allow you to do that. And bringing it home now is, that's what happened when Barclays was in South Africa. They bought Absa Bank. They then went into Africa. When they were in Nigeria, they found it very difficult to do business because most people don't have collateral. And if you don't have collateral, just like in South Africa, it's very difficult to get any loans, use collateral to be able to get access to funding. So what they did is they went and bought a company called Rainfin. They bought 25% of Rainfin. And that's how they went into into Nigeria, and they used Rainfin, because what Rainfin is, it's technology. It's similar to the Uber and Airbnb app. You have a lender and you have a borrower. The application is created, and on one side, it's one individual who says, I'm passionate for these kind of small businesses that I want to be part of or invest in. They go and put the requirements. On the other hand, you get the need where somebody says, I've got this capability and I want to build. And there's an algorithm in the back, whether it's AI or whatever, that actually maps the two people together, and then they meet and have the discussion to say, how can we support each other? I'd like to fund you. I love your idea. Can I take an equity stake in your business? Or can I get 20% or something of that nature? And that's another way of how funding can be made available to people.
Yeah, so I guess we're at the socioeconomic summit, so let's talk about socioeconomic factors, right? I mean, I'm the tech guy, I could focus on tech forever, but like when you look at like two big drivers for financial exclusion, right, if we talk about it. The first one is, if we had to look at it from a, from a liquidity perspective especially, like, why would I need to bank something when I have nothing to bank, right? We're quite well aware of the fact that the South African population is heavily indebted. We live in a very kind of like cash-heavy type of society as well. So, there's a lot of there's a lot of stuff that people need to spend. The economy's not been that great, right? What do you have to put into a bank account if you don't have anything to put into a bank account, right? I know it sounds overly simplified, but that's what it is. The other thing is when you look at like business. Business is a case of supply and demand, right? It's about generating profits and revenue, and again, very simplified, but like when you've got customers and customers come to you, right, to pay with something. If they come to you with a card and you don't have the ability to process the card, what do? You like look at their card, right? At the same time, if customers come to you with cash and you've got a cash point thing, and you just go like, right? We're not necessarily servicing both sides of the equation equally, right? I mean, you see a million Yoko devices and things everywhere nowadays, right? But like at the same time, if you look at the fact that customers don't necessarily have much to put into a bank account, right? You're looking at businesses not being able to use a card reader because it's still very much a cash economy. At the same time, you're looking at someone coming in with a card in a small business and saying, where do I swipe the thing now? Screw it, let me just take out $50 and pay you, right? When you look at those types of socioeconomic factors, we can put in all the tech in the world, but like at the same time, until we look at the broader things that need to be resolved, and especially from a banking side, look at servicing the demand and the supply from a customer and a business perspective, then we haven't really solved for much of the problem.
Sorry, Tejal, from a senior consulting perspective, and I know your role is probably trying to bridge the digital divide between those that have and those that don't. How do we see that private FSPs, financial service providers, can work towards achieving what National Treasury is first trying to achieve with regards to financial inclusion, and two, helping with technology and digital transformation per se?
So I think I just want to touch on something that Sachin meant. You can't really bank if you don't really have to bank. And then it goes off to the comment that you made earlier around creating those avenues for access to funding. So I think there's a couple of things that we need to consider in this. The first thing is the technology impediment that you mentioned. Reality, fact, 36% of our population has access to the internet. So if I've only got 36% of my population that has access to the internet, and if I'm going to come out and say, I need to transform your organization digitally, who am I really transforming it for? Am I transforming it because I'm trying to simplify your business process and include and drive a profit motive within the organization? Or am I transforming it to reach the other 64% that don't have access to the internet? So I think that's what we need to start looking at. And if I look at where I sit currently, both as an entrepreneur and as a corporate exec, I think the reality and the conversations that we are having with a lot of our clients, and especially the fintechs, is how do we reach the unbanked market? And what is it that the unbanked market wants to do? Now, if I look at a pilot that Unilever did in India and also in Kenya, it's around converting cash and getting these shops, the community shops, to become the banks in the community. Now, in South Africa, our banking market is highly regulated. We understand that, we know this, we've got to adapt to it. Now, it's how do we get involved as banking institutions, as financial services providers, as tech providers? How do we get a seat at the table of the regulators to take into account what is happening at a grassroots level? Because we do have access to these people. Our technologies are servicing these people. Now, I can only help drive the change if I'm at the table driving the policy. And the conversation that we're having at the moment, both with National Treasury, if you look at things like MSCOA, that they're trying to drive out across municipalities, and we know that has a big drive to reduce fraud. If we look at some of the other imperatives that National Treasury is driving, one of them needs to be looking at flexible regulation for the unbanked population in this country, because within that unbanked population also lies a tax base. There is a tax base that we could be getting, and that's lost revenue to the country. So we need to look at what exactly is the goal of the transformation initiative. How do we simplify the transformation initiative? And how do we bring technology to the table to manage the regulation, but also ensure that we get the revenue to continuously develop the country? And I think that's the conversation that we're not having. And for me, maybe as a takeaway from here, is how do we get in front of the banks, government, and the consulting houses to drive that three-way conversation?
Kevin?
So, there's many topics in here, right? I think the one thing is you can see the underlying is the poverty in the country. And I think we're not going to solve that just with technology. I think that's a bigger topic, because if you look at it, government has a role in creating the conducive environment for organizations to want to invest in the country so that you can get more investment. So that's one thing. The second thing is, if you look at SEPO created Stokvel. You remember most of our parents used to take money that they saved and 10 people and give it.
We call it a lottery.
We call it the lottery, right? SEPO took that and he actually created an app, which is Stockfellow, where people actually do that now, and it's over $1 billion rand. And that's how some people are able, yes, we don't want to put it into the banking environment, we put it in Stockfellow.
Yeah, Stockfell is almost a 70 billion economy.
Yeah, it's crazy what it's gone through, right? And the reality is people have their own ways of how they save. That's the one thing. The second thing is, if you look at Asha Pando, she created Sweep South. Now, there were challenges in the country because firstly, people battled to get employment. Secondly, people were not paid the right levels of salary. And thirdly, the high level of unemployment. So by creating that, she created a platform where helpers can actually register on this platform and they can choose where they want to work. They get above the minimum wage. If you look at the amount of people that are registered on this platform and the salaries that they actually generate from this, it's much more than working in other areas. Lots of people have become Uber drivers who have left their jobs to become an Uber driver. Some people full-time, some people part-time, whether it's Uber, all those things to be able to create additional revenue. So what we're saying is there's lots of opportunities out there, even Airbnb. If you have a house and you have an extra bedroom and you can't meet your rent, that's one way of generating extra to be able to do this. I think, as I said, we're not going to eradicate poverty in the short term, right? We've been 30 years into democracy and we're still sitting with this high unemployment rate, which is sad. But what I'm saying is, how do we actually find the right technology, the right solutions that can help those people that don't have access to the banks that they can't afford and create some mechanism where they can save in some way, they can keep their money where they pay low interest rates and also can take this money, because it's amazing how sometimes people that earn the least find ways to save and actually do something different and, in extraordinary ways.
Thuthuka, your African Bank, obviously, I see it's recently acquired Grindrod Bank to provide. African Bank was more an individual bank, and it's now venturing out into business banking. So what sort of initiatives are you taking, innovative initiatives are you taking to ensure that technology-driven solutions are made available? If you can just highlight some of that, and maybe from your understanding of the market itself, the banking market, your competitors, etc. What solutions are out there that are being provided to the financially excluded communities, so that they can have access to some sort of financial inclusivity?
Sure, brilliant question. The history of African Bank is quite fascinating, right? It's a bank that was started by entrepreneurs for entrepreneurs, at a time when, the black population couldn't really get access to financial services, so it was actually set up to give financial services to people that were marginally excluded. From a business banking perspective, we've looked at it in two ways. I think the first thing is there is a lot we can contribute to the overall success of SMEs, right? Not just from a banking perspective, but it's taking a lens that says, the failure rate of SMEs in SA is just too long, right? It's just too high. With the stats around, 50% of small businesses fail within 2 years, 70% fail within 5 years, right? So we then took a decision that says, let's create a division that looks at supporting SMEs and understanding what those failure points are outside of just financial services. SMEs are looking for access to market. Where's the next sale really going to come from? So it's how do you solve for that? They're looking for productivity and access to what we take for granted in corporate. If I need to talk to a marketing person or a lawyer or anybody else, or I need advice or a technology person, it's very easy for us to find. How do you allow SMEs to find those type of things? And then obviously access to finance and entrepreneurial development. So we've taken a lens that also says, how do we then help SMEs grow and thrive sustainably? From a tech perspective, then we've identified a couple of fintechs that we're partnering with, where we say, there's things that fintechs do well, right? They build fast, they go to market quickly, they listen to the market in terms of that. From a bank perspective, we can bring network and capital. And how do you bring those together? But the ultimate aim is you have to truly believe that you want to help the SME. I think that's one. So to your other question around, from an innovative perspective is, how do you look at giving them access to finance and giving them access to credit differently? By design, normal credit scoring is very judgmental. You've made X amount of money for this amount of time, I'm going to give you a loan or not. It doesn't take into account the fact that you've been improving, as an example. It doesn't take into account for the fact that your service is very satisfactory to some of the people that you provide servicing to. So what are the other data points that you can look at, and AI and digital comes to mind, that says, traditionally, we would not have financed you, but there are other aspects around your behavior that we can glean that brings you into the finance economy, and therefore you can be included. So that's how we've been looking at it from a tech perspective.
So I think one of the things that I want to allude to is we have banking regulation like AML, KYC. For those not in the banking sector, anti-money laundering and know your customer. And having been through core banking implementations with a few banks and having now working in the position where we support certain banks, I think the question for me, and it remains unanswered, and I don't think we're going to answer it here, is but how do we use things like AML, KYC, etc., to the point around having multiple bank accounts? How do I have a single bank account as a person and get segmented into having both a business profile and an individual profile? Now, if you look at small businesses, a minimum bank charge, if I were to go to an FNB, for a business bank account is 500 rands. What am I getting for that 500 rand? Now, for a small business, that's a lot of money. So why can't I use my individual account and be segmented as both a business and an individual customer? Comes back to regulation within South Africa. And I think that's where we as a collective need to then say to the regulators, because we are implementing it practically, we need to go back and say, it doesn't work. And how do we become more flexible? Going back to the earlier point around, your shopkeeper becoming the banker. How do we make that something that is, now I go back to the point of regulation, but how do we make that something formal? And maybe it is, the Stockfell apps, or maybe it is things like that that we design where you get a person, but then we go back to the 36% who don't have access to who only have access to technology. So we've got to look at this holistically, and we've got to look at infrastructure development, or we've also got to then look at going back from the smartphone. So our smartphones have taken over everything, and we expect that everyone has access to it.
Well, 92% of the people in the country, almost 92% of the people
have access to it. But also, we've then got to look at the cost of running the data to run the smartphone, right? So those are some of the things that are barriers to entry. While they are the platform for technology or technology enablement, the requirements to run that is also sometimes a barrier to entry. And I think those are the conversations that we need to look at. And I think, question, we think MTN, Vodacom, et cetera, are or not question, fact, we think MTN, Vodacom, et cetera, are the biggest providers of cell phones in this country. No, FNB is, right? So those are things that are, because with every bank account, you're getting a cell phone. So why can't I also, through my bank account, get access to the technology or the requirements to run that so that I can do the things that I need to do with the device that you're giving me?
So, Kevin, you want to say something?
Yeah, I think one of the biggest providers of cell phones in the country is actually PEP. I think it's PEP, Pepco Group that actually sells more cell phones than anybody else, because it's a lot of, if you look at the population that shops there. I think the other thing, the question we need to ask is, some banks, I'm not talking about the big four, but some banks originated from providing cross-border transactions. I don't know if you remember that. Because you find a lot of the Access Bank. So what happened is a lot of our people work in South Africa, but they come from other bordering countries, or some of the people that work come from the rural areas in South Africa that work in the urban areas don't have ability to go home often. So they had to make sure they're fending for their families and send money. And that's how the transactional fee, the cross-border happened. And then it got to a point where some organizations got so big that they had to become, registered and comply with the laws. So I think going back to those kind of things to understand what are some of the basic services that people require, and then looking to see what are the alternative ways to create this capability at a cheap cost. Because if you think about it, if you got such a big population that's unbanked, even if you have to charge 20 Rand or 30 Rand, can you imagine the amount of money that you'd make for a different platform? So those are the kind of things.
Okay. Just to a double-barreled question here for Sachin, in terms of your modalities around banking infrastructure. Yeah. So what's your view on the open finance model? 2, have we as a society learned from the Grameen Bank model? With regards to penetrating a market of seriously disadvantaged people, and especially entrepreneurs, and allowing them access to finance in order for them to grow. Yeah. Probably the third question, the final question, what is the possibility of us creating some sort of regulatory position on fee-less banking for micro business or SMME business? I think that's below 10 million and below 50 million. A fee-less banking, because as Tejal said earlier on, 500 Rand for a business, for a small business is a hell of a lot of money.
Okay, so I think it actually comes back to a couple of points that the panel's already mentioned, is that especially in the Grameen Bank type situation, and I think majority of that, if I'm not mistaken, was to women, right? Because the philosophy behind it was that not just based on their credit history and that was that women take the money, they use it to build businesses, they create more businesses, they support families, which help socioeconomic factors within that community.
But we have AI.
Yeah.
We have AI now, so it's easier.
Yeah. So essentially, I mean, it's a kind of a cascading snowball waterfall type effect, where you create a society where they're more able to pay back the money, build more businesses, therefore you get more fees and more loans and whatever else, right? And I think the thing, I think the one big thing that we need to stop doing, and it sounds horribly obvious, is that we need to to stop exclusivity from the financial services market is basically stop excluding people. Stop excluding people on the fact that everything that you do, especially around credit scoring and vetting and everything else, is based on retrospective factors, which is based on a very limited profile of what people are. Right? You take a number of factors, whether it's digital or not, you go onto an online application thing, you fill in 5 different fields or 20 different fields or whatever it is, and that's your view of the customer. The customer is not a person, the customer is not a number of different factors. They're not their personal spending habits, they're not their credit history, they're not all of these things, nor do you look at them as future potential, right? And I think that was the thing at a very simple level, particularly with Grameen Bank, was to say, who are the most likely to pay us back? Right? Who are the most likely to generate income, right? To help the community, to create a richer community, to get more loans, to build more businesses, to therefore pay more, right? And it comes back to the thing around feeless banking, is that banks often go to those types of things when there's a higher volume and the lower cost to service that customer, right? Therefore, obviously, everyone has moved to digital. Problem with everyone moving to digital is it still services that 30-something% of the market, right? You make it a lot easier for those people, drops the cost to service them, but when you looked at the unbanked market, you basically go, oh crap, they're very expensive, right? It's very high-touch environment, you've got to get a person there, and you've got to send up one of those gazebo tent things and all that kind of stuff, right? And then you're only getting small bank accounts from here and there, right? The thing is, in order to do that, you need to take a bit of a risk. To understand your customer in a specific area for specific businesses, understand the customer truly, not just as a set of criteria, retrospective criteria that scores that customer, but understand the customer in terms of their full profile and their potential. Target those locations, build that community, build those businesses, then you've got a kind of self-sufficient, you can lend, it'll lower the cost of service, right? You create the ecosystem like FNB tried to do. You sell the product, you sell the network, you sell the means to access the network, right? You've got the device, everything now, you can access this, right? You created an ecosystem yourself. You don't need to rely on anyone outside. You don't rely on the customer to have a phone. You've given them a phone. Don't need to rely on them to have a network, right? You've given them the network access. You've given them the banking app. You've given them access to the bank, right? You've dropped your own cost of service on your own.
Thuthuka?
No, I think we're very well aligned. I think we're saying the same thing, might be saying it differently, but 100% aligned. But I think I'd like to add something that you added as well. Regulatory is also quite big. Banks are heavily regulated. Who you lend to, how you lend to, there's this term called reckless lending. So there's people that even if you really wanted to lend funding to, if 5-6 years later the person is not paying back and they're in financial difficulty, we take the hit, and those are some of the things that we should be putting on the table from a regulatory perspective.
Kevin?
Yeah, I think, the one thing we haven't spoken about was micro-lenders. Now, I think, some parts of banking is very regulated, but there's also other areas that are not regulated. And I think, especially when people are in trouble and they need financial help, they go to these micro-lenders. And these micro-lenders take a lot of advantage of people that are in desperate need. Yeah. I mean, they charge, your 30, your 40, your 50%. So the question is, what are we doing about those? Because if we can get that sorted out and get it to a point where more people can go to them when they're in difficulty and come out on the other side better off than worse off, that would really help.
But shouldn't that then drive the innovation from within the system? the banking system, the financial sector system, to say that, well, listen, I've got a microlender here that's being what we call savage on one side, but on the other side, I've got all the resources to develop a more affordable product where the guy actually comes out better, but he'll come out even better. Saving a few bob here and there. Shouldn't you guys be driving that?
I think
those processes.
So I think this is the one big thing I've been thinking about a lot recently is, and you make a very good point, right? When you want to look at where your next set of services and your offering to the public and everything else is going to come from next, look a little at where the criminal aspect is operating from. If you think about who kind of came around with the whole iTunes single model, give you a specific thing as opposed to an album, you often think like, oh, Steve Jobs came up with it and went to the partners and whatever. No, it was Napster, right? Napster was a file-sharing platform where people shared their MP3s illegally, right? That's where the demand was. People didn't want to buy albums. People didn't want to do that stuff, right? They wanted to share the files. Yes, obviously it was free and illegal and whatever, and then the legal model came around with iTunes and all these other things, right? But that is the model that mimicked what people wanted. When you think about TV streaming piracy and things these days, right? They're telling you they're fed up with DSTV charging them 1,000 Rand a month, right, for a couple of sports channels they watch and 500 rubbish channels that they don't watch, right, with billions of adverts. It's the same type of thing. Like when you look at this, and it's, look at that model, look at what people want, look at what they're willing to pay for in a market that doesn't exist, create that offering. It's the same thing with this. They're willing to go to micro lenders, and yes, it's unscrupulous and whatever else, and they might break your kneecaps if you don't pay them back, right? The banks can't go and break kneecaps yet. But essentially what you're doing is you create the same product, create lower access points, right? Banks are naturally risk averse, right, for regulatory reasons and whatever else, but they also just do not ring fence parts of their business and take a risk. They do not look at the customer holistically, look at an area and then go in and try and sell the product, right? They want to have this massive approach, this big push, this campaign, right? And this is the issue with this, right? I mean, you can never then therefore implement that type of thing because there's a massive market for this micro-lender industry. Create a market similar to that. Create the DSTV competition, create the Napster competition, right? I mean, that's essentially what it should be.
So maybe just my last parting shot. I think if I look at all this, there's not one thing that's going to give you the solution. It's a series of things. It's what I call the building blocks to create something. The one is we need low-cost banking. The second is we need a platform that can take the unbanked onto it, but also have the right marketing strategy and the right approach of attracting these people by something that they want. Yeah. Now, if you look at Spotify, for example, Spotify, when it first came out, it allowed everybody free access. And then he said, if you want a premium service, you pay for something. So my question is, how do you take the micro lenders? How do you bring in regulation? How do you use technology and fintech to create the right solution with the right package to attract the unbanked to this with subscription models? Banks are not going to give it for free. But even if they have volumes and they can get the lowest fee is very small, and then they say for this 10 Rand or 20 Rand or whatever it is, this is what we can give you for free. But if you want that, you pay another 10 Rand. If you want, so you get subscription based, which is access to
incrementally. Thuthuka, your final.
Yes, yeah. Thanks for that. I think my final thoughts would be as well that as banks and as South Africa and the financial services market, you also don't want banks to provide everything, because that will create a very dominant set of players, which, I might be a banker, but I'm not sure that's what I want. You want to leave space for entrepreneurs. You want to leave space for innovation. You want to leave space for people to develop things and grow and thrive, right? So another way of looking at it is, how do we also support the people that are solving for these problems? Support the entrepreneur to support other entrepreneurs. I think that's another way of looking at it. Or back the innovators, because that will create an environment where there's a healthy ecosystem, there's healthy competition, there's sustainability, there's pressure on us from a pricing perspective, there's pressure on us to innovate, and I think that just becomes healthier for everyone on the ground.
Tejal, your parting shots?
I think for me, it's about creating inclusion. and it's also about creating opportunities for, to your point, entrepreneurs, and finding that three-way fit between public, private, and government. And I think that's what we've got to do, and we've got to do it with intent. So the collaboration forums need to be there. We all need to have a seat at the table in order to say, this is what works, and this is how we need to take it to market, and then we need to find a way to draft the regulation around it so that it is something that is not seen as irresponsible, criminal, etc., but also provides inclusivity.
Thank you very much to the panel. Earlier on, I did say that financial inclusion, creating an environment for financial inclusion is very critical in how we drive economic growth and sustainability. I think the issue of bringing in people into a system is not an easy one because of the regulations. And the technology, maybe some technology impediments, because, we can offer all the technology. If you don't have broadband and Wi-Fi in a rural area, you can't then implement the solution. So I think it's a conversation that we must constantly be on the button on, and make sure that, as you said earlier on, that the regulators, the Reserve Bank, the National Treasury, etc., needs to be on the button in ensuring that they deal with the impediments that are the real impediments that are faced on the ground, as opposed to what is perceived out there. And a lot of our, as the previous panel said, a lot of the research is quantitative. The qualitative research shows that there's still challenges in this environment. So I'd like to thank the panel. I'd like to thank the audience as well for listening to the panel. I'm sorry I didn't give you an opportunity to speak on some of the issues.